Well, it is going to be quite a bit of a revenue challenge for Chinese bank this year. As mentioned, with the reduction in the loan prime rates and also that hitting the mortgage lending, we estimate that we'll have about a 6 basis point impact to bank earnings over the course of this year and next year. And that's on top of almost 22 basis point decline in net interest margin from 2022 to 2023. So that reduction in net interest margin will continue to pressure revenue growth for Chinese banks this year. At the same time, while banks are being asked to finance selected property development projects or infrastructure projects, the government also want banks to be doing these projects at lower cost. So it's a bit of a double whammy for banks in terms of their revenue pressure this year.
Yeah, and to sort of mitigate the increasing pressure on NIMs, banks are more likely than not going to have to lower deposit rates as well. And I want to pull this a little bit broader and ask you about the likelihood of, I won't go so far as to say a run, but certainly we're seeing a lot of Chinese money where that money is liquid and also movable, leaving not just banks, but leaving any kind of assets in China and heading offshore. How much of a challenge is this going to be for China's banks?
Well, because there are still capital controls in place, so a lot of the deposit and the banking system itself still remains predominantly domestic funded. So that still reduces a lot of the liquidity or funding pressures that we might see elsewhere, where countries go into issues around leverage, right? So in China, it's still very much a domestic problem because it is still domestic state-owned banks lending to state-owned companies. It's a system that's domestically funded. And also what we've seen in recent years with things like wealth management products, for example, the appetite has actually been gradually declining since 2017 when the authorities started to crack down the unsustainable growth in that sector. So by and large, what we've seen is that the depositors themselves are actually have become quite cautious in terms of investing in these high-risk products. So even with reductions in deposit rates, actually, retail deposit growth continues to be quite strong. So that's one of the silver linings for China's banking system.
Okay, that's the trade-off, Grace. I'm curious to get your thoughts now on the banks issuing these loans as part of this Project Whitelist. The folks over at the Nikkei said that this is about $18 billion we're seeing here. But they also talk about how recent comments from lenders are showing a hint of caution. They've pointed out the Bank of China specifically have said that they're only going to be catering to projects who have sufficient collateral, rational assets and liabilities and guaranteed resources for repayment. So what does that tell you in terms of the banks sort of being caught between a rock and a hard place at the moment? They've been very hesitant to actually increase their exposure to these property developers, but it seems that they're getting some pressure from the authorities saying, hey, look, guys, it's okay to extend these loans to these companies.
Yeah, because the priority is very much on ensuring project completion. So banks will be very selective in terms of looking at these property projects on a project-by-project basis, because it is still important to ensure that they're safeguarding their asset quality. Right? We talked about revenue pressure earlier, but equally important is the asset quality aspect. So for banks, I think first and foremost it's still very important for them to safeguard their asset quality. So ensuring that they are choosing the viable projects, right, to help ensure completion, because I think that's one of the root problems that China is facing at the moment. It's not so much about household affordability, it's whether the average home buyer has enough confidence that these property projects will be delivered on time.